Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, June 4th. The market's reaction to OECD's downgrade for the global growth projection saw little reaction from investors. Investors actually continue to see the glass half full or just a bit full, but FOMO, telco, or the Fed dose, whatever it is, the rally remains intact. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own, and this is not financial advice. So yesterday was surprisingly good in terms of market performance when you think that, well, the day in the US began with a deep cut in growth projections from the OECD due to substantial increases in trade barriers, tighter financial conditions, and weakened business and consumer confidence around the world. And I think that it kind of summarizes quite well and quite well comprehensively the underlying reasons why everybody, including we, expect the world economy starting from the US to slow this year. And that's also what the OECD thinks, mind you. They think that the US will be the hardest hit among the major economies. Japan will also feel the pinch of the rising trade tensions, while the projections for Europe remain quite steady, maybe due to an ample support from the ECB expected due to inflation under control. So the euro area should continue to grow slowly as well, but the gap between the US and European growth rates will converge towards each other due to a significant slowdown of the US economy. So that is exactly what the euro's appreciation against the US dollar this year has been telling investors since the beginning of this year. In fact, the pair somehow struggles to advance above that 115 psychological level these days, with a strong but quite strong range of offers above the 114.50 mark. But should the US trade chaos continue, the pair will end up clearing these offers and throw itself into the 115-120 range for this summer. And looking at the latest news, there is a more plausible, though undesired, scenario because Donald Trump's latest tax rises on steel and aluminum from 25% to 50% are going to be effective from today. So why on earth are US stocks still bought on dips? Well, there are several explanations for that. The FOMO, the fear of missing out the rally, the TACO, Trump always chickens out, or the economic data and Fed expectations. But the trade news were not great yesterday, as I said, and economic data was quite mixed, and the Fed is not expected to cut the interest rates. In numbers, the JOLTS data printed a higher than expected number of job openings in the month of April, and that actually hinted that the US jobs market is weathering the Trump shock, the Trump turmoil relatively well for now. But the factory orders slumped 3.7% during the same month. That was not good news, and that was more than expected by analysts. And because the Federal Reserve is unwilling to cut the interest rates, as I said, with a significant jump in inflation expectations due to Donald Trump's tariffs, while soft economic data from the US cannot fully explain why the S&P 500 is advancing to 3-month highs right now. So it's certainly FOMO, the fear of missing out a rally, and it remains fragile. Investors will be watching the ADP report and a series of ISM non-manufacturing data today to assess the strength of the US economy. But again, because the US Fed cannot do much to help fuel growth and growth expectations when inflation is seen rising, strong economic data from the US should back further gains in equities, while soft data can maybe, but just maybe, encourage a retreat. But maybe not, because stock markets and investors have their own agenda, and the simple fear of missing out a potential rally in the US stocks is enough to keep optimism going, and that regardless the number of bad news and number of soft projections and bad data that we have out there. Because soft projections and soft data there are, mind you, after a surprise decline that we saw in Chinese PMI manufacturing number announced earlier this week, while Australia just printed softer than expected growth numbers for the first quarter of this year earlier this morning, and the Bank of Canada is expected by some to trim its interest rates by 25 basis points when it meets today. But because some surveys actually point at no change from the Bank of Canada, I believe that the decision is not fully priced in just yet, and a rate cut from the BOC could actually trigger further appreciation of the CAD, fueling growth expectations for the Canadian economy, while a no change from the Bank of Canada rates today could encourage some repositioning. But the fact that the US dollar remains under a decent selling pressure around the world, hence that the dollar CAD could eventually continue to retreat, and it has actually room to do so, because note that in June 2021, so just 4 years ago, the pair was trading near the 120 mark, and it is now at an important crossroads. It's slight below the 137 level, which is the major 38.2% Fibonacci retracement on that 4-year rise of the dollar CAD will actually send the pair into a long-term bearish consolidation zone and could pave the way for further decline toward the 130-133 range. And the latter fits the narrative of further weakness expected for the US dollar as well. And speaking of that, according to Alliance SE, a foreign tax provision in Trump's spending bill could lead to a 10% sell-off in US equities and another 5% depreciation of the US dollar. So that provision would actually aim to increase tax rates for individuals and for companies from countries whose tax policies that the US deems discriminatory, which could be seen as a form of capital control, says Bloomberg, and the US accuses everyone for being discriminatory anyway in multiple areas. So that is also an affair to be followed by investors. For now, though, the US stocks remain in demand, as I said, with the technology giants, the technology stocks carrying the major indices higher again. Nasdaq slowly approaches its all-time high level hit this February as Nvidia pushes above the $140 psychological mark. The company actually dethroned Microsoft this week and became the most valuable company of the United States and also of the world, of course, with a market cap of around 3.45 trillion US dollars. And the PE ratio sits around 45. That's higher than S&P 500 companies average, but it's not a shocking level for a tech company that is certainly benefiting from a certain dose of speculation around the world. It's because their earnings follow up, and that's what makes Nvidia still a strong bet for AI investors even at the current prices. And zooming out, the US remains the major go-to market for the technology investors as the Chinese tech giants actually failed to gain momentum after the initial DeepSeek rebound of the beginning of this year. It is still interesting, in my opinion, to have some exposure to the Chinese technology stocks, as it is, I think, just a matter of time before more innovation breaks and the rally begins again. But the day the rally begins, you might be too late. Now, in Europe, the luxury good makers are losing ground against the military stuff makers these days. The German Rheinmetall is now part of the Euro Stoxx 50 index as Kering dropped out. So indeed, the morose appetite from the Chinese consumers and import taxes from Americans will make the outlook for the luxury bags and champagne look quite weak these days, whereas the rising geopolitical tensions in Europe and around the world and the European government pledges to increase their spending in defense backs inflows into the European defense companies, obviously, and beyond the defense companies, the softening European inflation and prospects of further interest rate cuts from the European Central Bank remain supportive of the Stoxx 600 index and the Stoxx 600 valuations, although the upside potential in most Stoxx 600 companies is obviously not comparable to your American technology darlings. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.